ProShares Bitcoin Strategy ETF, BITO 9, what questions you're afraid to ask, but should know. Hey everyone, and welcome to the channel. Today, we're diving deep into the world of Bitcoin, and taking a close look at the ProShares Bitcoin Strategy ETF, also known as BITO. This ETF has been gaining a lot of attention, but before you jump in, there are some crucial questions you need to ask. What exactly is BITO doing under the hood? How does it track Bitcoin compared to the real thing? Can you easily buy and sell BITO shares? What are the potential risks involved? How does the issuer manage these risks? What happens when Bitcoin prices go crazy? Is BITO prepared for future changes in the crypto market? Buckle up, because we're about to answer all these questions and more. Get ready to demystify BITO and make informed investment decisions about your Bitcoin exposure. Let's go. Question 1. What is the underlying investment strategy of the ProShares Bitcoin Strategy ETF of BITO? While BITO is often marketed as a way to gain exposure to Bitcoin, it's crucial to understand that it does not directly invest in Bitcoin itself. Instead, its underlying investment strategy relies on Bitcoin futures contracts. Here's a breakdown. Futures-based strategy. 1. BITO seeks to track the performance of Bitcoin by investing in near-month and next-month Bitcoin futures contracts traded on the Chicago Mercantile Exchange, CME. 2. These futures contracts represent agreements to buy or sell Bitcoin at a predetermined price on a specific future date. 3. By rolling over maturing contracts, BITO aims to maintain continuous exposure to Bitcoin's price movements. Key points here. 1. Not direct Bitcoin ownership. You don't actually own any Bitcoin when you invest in BITO. Instead, you're exposed to price movements through futures contracts. 2. Rolling over contracts. This process can introduce tracking errors and additional costs due to contango or backwardation in the futures market. 3. Managed by ProShares. The fund manager actively rolls over contracts and may use other strategies to manage exposure and risks. Understanding the implications. 1. Volatility. Futures contracts can amplify Bitcoin's already volatile price movements, potentially leading to larger swings in BITO's value. 2. Tracking errors. BITO might not perfectly track the spot price of Bitcoin due to rolling costs and other factors. 3. Costs. Rolling over contracts and other management fees contribute to BITO's expense ratio, which can be higher than directly holding Bitcoin. Question 2. What specific factors drive the BITO daily performance relative to Bitcoin prices? Several factors can influence BITO's daily performance relative to Bitcoin prices, even though it doesn't directly hold Bitcoin. Here are some key ones. 1. Bitcoin futures basis. Contango. When the price of a futures contract is higher than the expected spot price at the contract's expiry, contango, BITO's price can underperform Bitcoin as it incurs costs when rolling over contracts. Backwardation. Conversely, when the futures price is lower than the expected spot price, backwardation, BITO can outperform Bitcoin as it benefits from cheaper roll costs. 2. Tracking error. The process of rolling over futures contracts can introduce tracking errors due to differences in timing, bid-ask spreads, and other factors. This can cause BITO's price to deviate from the theoretical performance based solely on Bitcoin's price movement. 3. Management fees. BITO charges an expense ratio to cover its management fees. These fees eat into the fund's returns, and their impact can be amplified if Bitcoin's price is stagnant or declining. 4. Market sentiment and liquidity. Changes in market sentiment towards Bitcoin can affect the price of both Bitcoin and Bitcoin futures. If sentiment sours, both might decline, but BITO could be impacted further due to potential decreases in liquidity and wider bid-ask spreads in the futures market. 5. Unexpected events. Unforeseen events like regulatory changes, exchange outages, or major news affecting Bitcoin can cause sudden price swings in both Bitcoin and BITO, potentially leading to significant performance divergences. Question 3. What is the liquidity of BITO shares? Can they be easily bought and sold in the market? BITO shares typically boast good liquidity, meaning investors can generally buy and sell them easily in the market. Here's a breakdown. Positives. 1. High trading volume. BITO consistently ranks among the most traded ETFs, indicating significant buying and selling activity. This creates a deeper market and potentially tighter bid-ask spreads. 2. Large market capitalization. BITO's market cap, as of February 18, 2024, sits above $1.15 billion, further contributing to its liquidity. 3. Multiple exchanges. BITO trades on major exchanges like NYSE Arca, ensuring broader accessibility and potential for higher liquidity. Nuances to consider. 1. Intraday fluctuations. While overall liquidity is good, it can vary throughout the day. Bid-ask spreads might widen during less active periods, impacting execution prices. 2. Market volatility. Intense market swings, especially regarding Bitcoin or the broader financial landscape, can affect BITO's liquidity. Spreads could widen temporarily, potentially impacting execution prices. 3. Order size. If your order size is significant compared to the typical trading volume, you might experience more difficulty finding matching buyers or sellers, potentially leading to less favorable execution prices. BITO shares generally offer good liquidity compared to many other ETFs, especially considering its relatively new launch. However, it's important to be aware of potential fluctuations and the impact of order size on execution prices. Question 4. What are the risks associated with investing in BITO? While BITO offers an indirect way to gain exposure to Bitcoin, it comes with its own set of risks compared to directly holding Bitcoin. Here's a breakdown of some key risks to consider. 1. Bitcoin price volatility. Bitcoin is inherently volatile, and its price swings can be significant. Even if BITO tracks Bitcoin's price movement perfectly, you're still exposed to this volatility, which can lead to substantial losses. 2. Tracking error. Due to factors like rolling over futures contracts and management fees, BITO's performance may not perfectly mirror Bitcoin's price movements. This tracking error can further amplify losses or limit gains compared to direct Bitcoin ownership. 3. Futures-based strategy. BITO's reliance on futures contracts introduces additional risks like contango, where futures prices are higher than the expected spot price, and backwardation, opposite of contango. These can negatively impact BITO's performance compared to Bitcoin. 4. Regulatory uncertainty. Cryptocurrency regulations are still evolving, and any significant changes could impact the Bitcoin market and BITO's operations. This uncertainty adds an extra layer of risk to the investment. 5. Counterparty risk. BITO invests in futures contracts issued by the CME. If the CME encounters financial difficulties or defaults, it could impact BITO's ability to meet its obligations, potentially leading to losses. 6. Management fees. BITO charges an expense ratio to cover its management fees. These fees eat into your returns, and their impact can be magnified during periods of stagnant or declining Bitcoin prices. 7. Liquidity risk. While BITO generally has good liquidity, it can fluctuate in volatile market conditions. This could make it difficult to buy or sell shares at your desired price, potentially leading to losses. 8. Security risks. Any investment involving digital assets carries inherent security risks, such as hacking and cyber attacks. While BITO itself employs safeguards, these risks cannot be entirely eliminated. 9. Limited voting rights. Unlike owning Bitcoin directly, BITO doesn't grant you voting rights on the Bitcoin network. This means you have no say in the governance of the underlying asset. 10. Lack of diversification. BITO primarily focuses on Bitcoin exposure, which offers limited diversification within your portfolio. Consider your overall risk tolerance and investment goals before investing in a single asset class. Question 5. What is the issuer's strategy for managing risk in BITO? ProShares, the issuer of BITO, employs various strategies to manage risk in the ETF, though it's crucial to remember that no strategy can eliminate all risks. Here's an overview of their approach. 1. Diversification within futures contracts. BITO doesn't solely rely on a single Bitcoin futures contract. Instead, it invests in multiple near-month and next-month contracts, aiming to mitigate the impact of fluctuations in the price of any single contract. 2. Rolling over contracts. BITO actively manages the rollover of expiring futures contracts to maintain exposure to Bitcoin's price movements. This process involves considering factors like contango and backwardation to minimize tracking errors and potential negative impacts. 3. Risk monitoring and adjustments. ProShares continuously monitors market conditions and BITO's performance. They might adjust the ETF's exposure based on their risk assessments and market trends, aiming to optimize risk return within the constraints of the chosen strategy. 4. Transparency and communication. ProShares provides investors with regular reports and updates on BITO's performance and risk profile. This transparency allows investors to stay informed and make informed decisions about their holdings. 5. Underlying exchange risk management. BITO relies on the CME, a reputable and regulated exchange, for its Bitcoin futures contracts. This helps mitigate counterparty risk associated with the futures market itself. Question 6. What hedging strategies are used to manage BITO's exposure to Bitcoin volatility? It's important to clarify that BITO itself doesn't directly employ hedging strategies to manage its exposure to Bitcoin volatility. This is because BITO doesn't hold any Bitcoin directly, but rather tracks its price movement through Bitcoin futures contracts. However, the inherent nature of these futures contracts introduces some hedging-like characteristics here. 1. Diversification within futures contracts. As mentioned before, BITO invests in multiple near-month and next-month Bitcoin futures contracts, instead of relying solely on one. This diversification helps spread risk across different contract maturities and potentially reduces the impact of price fluctuations in any single contract. 2. Rolling over contracts. The process of rolling over expiring contracts to maintain exposure involves buying new futures contracts with further expiration dates. This inherently involves selling the expiring contracts, which can sometimes act as a hedge against short-term price movements in the opposite direction. However, it's crucial to remember that rolling introduces tracking errors and potential costs due to contango or backwardation. 3. Contango and backwardation. Depending on the market conditions, the futures prices can be higher, contango, or lower, backwardation, than the expected spot price of Bitcoin at the contract's expiry. While not explicitly intended as a hedging strategy, contango can provide some buffer against price declines in the underlying asset, Bitcoin, while backwardation can act as a hedge against price increases. However, these conditions also come with their own risks and costs. 4. Underlying exchange risk management. By relying on a reputable and regulated exchange like the CME for its Bitcoin futures contracts, BITO inherently mitigates some counterparty risk. This can be seen as a form of risk management, although it doesn't directly address Bitcoin's inherent price volatility. Key takeaways. 1. While BITO doesn't have traditional hedging strategies, the structure of its futures-based approach introduces some inherent risk-mitigating characteristics. 2. Understanding these characteristics is crucial for evaluating the potential risks and returns associated with BITO. 3. It's important to remember that these characteristics can't eliminate Bitcoin's inherent volatility and don't guarantee positive returns. Question 7. What is the issuer's approach to rebalancing BITO's holdings? ProShares, the issuer of BITO, doesn't employ traditional rebalancing like you might see in a typical diversified ETF. Instead, due to its unique structure and reliance on Bitcoin futures contracts, BITO's holdings are constantly adjusted through a dynamic management process. Here's how it works. Continuous contract rolling. BITO primarily tracks Bitcoin's price by holding multiple Bitcoin futures contracts with different expiry dates. As contracts approach expiry, typically monthly, they are systematically rolled over into new contracts with further expiration dates. This rolling process is not a fixed event, but rather an ongoing activity to maintain exposure to Bitcoin's price movement. Dynamic adjustments based on market conditions. While the core strategy involves rolling near-month and next-month contracts, ProShares can make adjustments based on market conditions. This might involve adjusting the weightings between near-month and next-month contracts based on their relative premiums or discounts. Shifting to slightly longer-dated contracts during periods of high contango, when futures prices are higher than the expected spot price, to potentially reduce costs. Utilizing other futures strategies like calendar spreads or options overlays in rare circumstances for more targeted risk management. Transparency and communication. ProShares strives to be transparent about BITO's composition and investment strategy. They provide regular reports and updates, including information about the weightings of different futures contracts and any adjustments made. Key points to remember. 1. BITO's holdings are continuously adjusted through contract rollovers and potential strategic adjustments, not through traditional rebalancing events. 2. The specific weightings and adjustments are dynamic and depend on market conditions and the issuer's assessment. 3. Investors should be aware of this dynamic management approach and its potential impact on BITO's performance and risk profile. Question 8. What is the impact of contango and backwardation on BITO's long-term performance? Contango and backwardation, the conditions where Bitcoin futures prices deviate from the expected spot price at expiry, can significantly impact BITO's long-term performance. Here's a breakdown. Contango, futures price more than expected spot price. Negative impact. When contango exists, BITO consistently buys futures contracts at a premium compared to the expected future price of Bitcoin. This eats into the ETF's returns over time, as it needs to sell these contracts at a lower price to realize its exposure. Example: imagine BITO buys a Bitcoin futures contract for $50,000 with a 1-month expiry. If the expected spot price at expiry is $45,000, contango, BITO would suffer a $5,000 loss per contract even if the actual Bitcoin price remains unchanged. Backwardation, futures price less than expected spot price. Positive impact. When backwardation occurs, BITO buys futures contracts at a discount compared to the expected future price of Bitcoin. This can boost the ETF's returns over time, as it profits from selling these contracts at a higher price. Example: imagine BITO buys a Bitcoin futures contract for $45,000 with a 1-month expiry. If the expected spot price at expiry is $50,000, backwardation, BITO would gain $5,000 per contract even if the actual Bitcoin price remains unchanged. Long-term implications. 1. Contango can significantly erode BITO's returns over extended periods, especially if the contango is persistent. This is because the negative impact compounds over time as BITO continuously rolls over contracts at a premium. 2. Backwardation can provide some performance benefits, but it's less common and may not always offset potential losses from contango periods. 3. The impact depends on the frequency and duration of contango and backwardation. Even short periods of contango can have a noticeable effect, especially when considering the ETF's expense ratio. Question 9. What are the issuer's plans for adapting BITO to changes in the cryptocurrency market? While ProShares, the issuer of BITO, hasn't explicitly announced any concrete plans for adapting BITO to significant changes in the cryptocurrency market, it's possible they might consider different approaches depending on the nature of the change. Here are some potential scenarios. 1. Regulatory changes. If regulations surrounding Bitcoin or cryptocurrency futures contracts undergo significant changes, ProShares might need to adjust BITO's underlying strategy to comply with the new regulations. This could involve shifting to different types of futures contracts, or even alternative investment vehicles depending on the specific regulations. Modifying the ETF structure or investment objective to stay within permissible boundaries. 2. Technological advancements. If technological advancements significantly alter the way Bitcoin or other cryptocurrencies function, ProShares might need to adapt BITO to reflect these changes. This could involve introducing exposure to different cryptocurrencies beyond Bitcoin if they become more prominent or relevant. Utilizing new trading strategies or investment vehicles that emerge in response to the technological changes. 3. Market structure shifts. If the structure of the Bitcoin futures market undergoes major changes, such as the introduction of new contract types or exchanges, ProShares might need to adjust BITO accordingly. This could involve adapting the ETF's exposure to different futures contracts based on their liquidity and risk profile. Utilizing new trading strategies that take advantage of the evolving market structure. 4. Significant price movements. While less likely to require a direct adaptation of BITO, ProShares might consider adjustments if Bitcoin experiences extreme price movements or volatility. This could involve communicating more frequently with investors about the risks and potential impacts of the market conditions. Utilizing temporary risk management strategies within the existing framework of BITO's investment objective. So there you have it. We've explored the ins and outs of BITO, covering its investment strategy, risks, performance drivers, and more. Remember, BITO isn't just another ETF. It's a unique way to gain exposure to Bitcoin with its own set of considerations. Before you decide if BITO is right for you, be sure to do your own research, consider your risk tolerance, and consult with a financial advisor. But hey, at least you're now armed with more knowledge to make informed choices. What are your thoughts on BITO? Do you think it's a good way to invest in Bitcoin? Let me know in the comments below. Don't forget to like and subscribe for more insightful content on the crypto world. Thanks for watching.